Good evening, everyone. I think it's a good opportunity to reconnect with all our investors and prospective investors, especially when the markets have been so turbulent and with all sorts of macro announcements from time to time. Obviously, the investor confidence is kind of pretty low. But just to start off, next slide, please. Just to start off, this is how the entire year kind of panned out. It was, by comparison, a pretty lackluster year for Nifty 50, if I were to talk about the broader markets. Uh, Returned just about 5% when you compare that with the previous year's return of about close to 30%. It seems like it was a very, very uneventful year. Uh, when we compare the last 15-year returns, FY25 was also amongst the bottom five in terms of the return performance of the broader markets. But the markets obviously have not delivered exactly the kind of the kind of event that actually transpired during the year. From an event perspective, it's been a very, very eventful year, both from a political landscape point of view as well as from a monetary landscape point of view. So in terms of political changes, I think it's pretty clear by now that there was an election which happened in June domestically. The India came back to power, but with a weaker majority. Trump won the 2024 presidential elections in November. He assumed office in January, and obviously there has been a lot of turbulence ever since he took office, and we'll talk about that in the later half of the presentation. In terms of policy making, in terms of monetary policy specifically, we've seen the U.S. Federal Reserve kind of cut rates for the first time since the pandemic. This happened in September 24, and since then there have been multiple rate cuts by the U.S. Federal Reserve. In February 25, the Reserve Bank followed the U.S. Federal Reserve in cutting rates, and it was the first rate cut by the RBI ever since the pandemic. So from a monetary as well as from a political landscape point of view, it's been an eventful year, but the markets have obviously been pretty lukewarm. Next slide, please. I think this has been amongst our top discussions with every investor, and we've decided we'll take this discussion slightly longer because it's a common question that all of us have, and it's a good opportunity for us to have a relook as to how we're thinking about these developments. So last 30 days, I think it's been pretty volatile. Trump announced a number of policies with respect to a lot of countries. It started with some policy changes for countries such as Mexico, Canada. Then in the month of March, all sorts of announcements were made for the Chinese economy. And of course, followed by the 2nd April Liberation Day, where a large amount of reciprocal tariffs were announced on about 60, 70 odd countries. These actions have obviously, kind of sparked some kind of global backlash. There have been legal challenges, there have been inflation fears, and the markets are actually bracing for some kind of changes in trade policy. It may not be as rigid as it sounds today, but the markets are kind of factoring in some bit of uncertainty, and that's the reason behind the volatility. The administration has also announced some of the rationale for the changes in trading policy. They range anywhere from bringing manufacturing back into the US to acting against unfair trade partners, unfair trade barriers. And it's also a lot about their own national security in order to reduce dependence on certain geographies. So it seems that the tariffs have been imposed largely to secure better trade deals and assert the US's economic sovereignty. Next slide, please. Like I said, markets have, obviously been surprised by how intense these announcements have been, especially what was announced in 2nd April. If you look at the three main indicators in the US, and we'll talk specifically about the US because it's been the most impacted. The first one, which is the volatility index, and which is often called the fear gauge of the Wall Street that kind of shot up after these announcements. And even as we speak today, they're nowhere close to what they were before the announcements actually made their way. The US 10-year bond yield, which was on a gradual decline in line with the actions taken by the US Federal Reserve, that popped up. The yields kind of went 50 bips in less than a week, right? And that's a huge move for something as liquid and something as priced as the US 10 years. The third is the dollar index. The dollar index has been on a constant decline ever since the new administration assumed office. These were exacerbated by the tariff announcements. Today, as we speak, the dollar is itself kind of cheaper by about 10%. So these are very, very drastic moves in the financial markets. They've not taken these announcements very positively. And yeah, so the next one is, can you move on to the next slide, please? Yeah. The general what we all want to actually have a view on, whether to what extent are we factoring in the tariffs, what kind of tariffs will go on to be permanently placed on each of the partner countries, and how will all such economies kind of get impacted. But we'll just run you through as to why we think the markets will be volatile, because like I said, there are certain indicators which have shot up, adversely. They have led to losses in many bond books, losses in many currency books, because the move was unexpected. And we see this kind of volatility kind of continue. But at the same time, we also believe that tariffs as they stand today might not stay where they are. And we have seen some evidence of that in the in the days following the Liberation Day, where a lot of exemptions were made. Many tariff policies were kind of, the tariff rates were kind of, they went into a 90-day pause. So there's been a lot of volatility with respect to how policy making has happened at the administration's end. And as a result, the market is obviously now kind of trying to figure out exactly what is the status quo, what is the sustainable level of tariffs. The other two aspects of the tariffs going through in their current form is the long-term impact on the US consumer. This is, I mean, it's par for the course that this is kind of inflationary for the US consumer, because the cost of goods kind of goes up if you change supply chains from something which is very efficient to something which is less efficient. Secondly, it's bad for global growth. Whenever you introduce such barriers on trade, there are going to be impact on global growth, and a lot of policymakers have announced. Some of the world bodies have kind of revised their global growth measures, not by a large margin, but at least some bit of moderation in estimates of growth has already started trickling in. The tariffs have obviously been criticized by a number of business leaders, as well as some of the Republicans themselves, citing kind of tough midterms for the current administration if these kind of economic policies are pursued in the coming quarters. Next slide, please. So that brings us to the question as to what all these developments kind of imply for the Indian markets, for the Indian investors who are kind of aligned, kind of exposed to the Indian markets. But long story short, it's been, at least from an Indian markets point of view, we've not seen as much volatility as the US markets have seen. Next slide, please. So for example, we've been talking about a lot of these heavy drawdowns. These got worsened by the tariff announcements. And we've seen the 16, 17 odd percent drawdown, which was existing till about a few weeks back. And also the similar drawdown which we saw in the year 2022. We've seen none of this impact in the retail investors as a pool, right? In June 22, July 22, we saw the SIP book kind of remain stable at about 12,000 crores, despite 16, 17% drawdown. In March as well, for which the numbers are just out, We saw the SIP book again remaining stable at about 26,000 crores despite the 16-17% drawdown. If you were to look at the rolling 1 year returns, the rolling 1 year returns for the Nifty 50 have been below 10% since January, and we have seen none of that impact any of the SIP, book investors. Next slide, please. Secondly, what we are also observing is that India's inflation is largely in control at the moment. The repo rate, as a result, is being brought down. It was at about 6.5% for the longest time, and the RBI, like I initially mentioned, has reduced the interest rates for the first time since the pandemic. They have also instituted another rate cut in the April policy, which obviously does not get captured in this chart because we're talking about the financial year. But we are looking at about 50 bips drop in rate cuts, drop in the repo rate in response to the declining inflation. And as capital kind of becomes cheaper, it kind of ensures that the equity markets start looking a lot more attractive. Next one, please. Yeah, so this is a slide where we're talking about the equity risk premium, which is a metric which is tracked world over for different equity markets. It's basically a measure of how attractive the equity markets are versus the relative or related bond yields. What we've seen is that the equity risk premiums have kind of risen in the last couple of weeks. They are the highest now today in the last 4 years. So if you were looking at hiking your investments into the equity markets in a block of 4 years, this is possibly the best time to do that. As like I said in the previous slide, as capital becomes cheaper, as the GSEC yield kind of contracts, in the face of lower equity market multiples, the equity risk premium is going to look rosier and rosier. Of course, we've seen many events in the past. For example, in the chart, as you can see, during the COVID years, it was very, very high, unnaturally high. We might not see those levels again, but these are definitely times, at least the markets are telling us, that these are definitely times where we can very closely look at increasing investments into the equity markets. To give you an example, in 2020, 2021, which is a period which was outside of the COVID years, the market saw very sharp acceleration. So in a couple of quarters time, the markets rose 30-40% from the current levels of ERPs. So that is how significant these levels are, and these definitely give us a very attractive entry point when we are looking at equity as an asset class. Next slide, please. Now, this is the last one where we're talking about how over the last many months, this has been a recurrent question on everyone's mind, that the sell-off which started in September 24, it's kind of continuing because of the heavy selling pressure from the FIIs. And what we are seeing is that March was the first month since the sell-off actually began in September, where FIIs actually net bought domestic equities. We saw, so it's kind of premature to comment on April. April first few weeks, like I said, because of Liberation Day, were pretty volatile. But those sell-offs in the first week of April are gradually getting amended as we speak. We'll see how April pans out, but things are looking much more positive right now. Next slide, please. The second part is that, okay, this is what is happening globally, and this is what is happening in the Indian markets. What do I actually do with my asset allocation? And we thought at this point in time, there are two very actionable, actions or actionable events that one can take when one is talking about the portfolio. Next slide, please. The first is for those of us, for those investors who we have interacted with in the past, we've been fairly bullish on high duration debt books. We've on many accounts, we've taken high duration debt calls for many of our investors, citing very high interest rates, very high real rates. and rates coming down being only a matter of time as inflation moves into a much more sustainable trajectory. So that has kind of started playing out much more effectively in the last couple of quarters. Uh, in the last 12 months itself, the 10-year GSEC has dropped by about 80-90 bips. We've had very strong gains for some of our long duration debt holdings. We were at this point in time, we're obviously continue to be of the view that the rates are uh, do have much more ground to cover because the rates are still very, very high. And as an economy, we cannot have high real rates for a long time. So at this point in time, we are suggesting you to reduce the duration of the book. And as successive levels on the repo, as successive levels on the 10-year GSEC are reached, it is advised that we start booking long duration investments and start moving into a lower duration or equity market allocations because the story has started playing out, but then there is an objective of profit booking as well. We continue to see this story kind of play out as mentioned by the RBI governor during his April 25 statement that there is much more confidence within the RBI when it comes to inflation outlook. So we continue to remain positive about the rates, but at the same time, we are obviously recommending reduction in the duration of the bond portfolio. Next one, please. The other one is on gold. This has been a recurrent question again, and we thought that we address this much more systematically because the gold as an asset class has obviously surprised all market participants. In most pockets, it is generating at least at par or slightly better than broader Nifty 50 returns. But we have obviously been bullish about gold for a very long time. But at this point in time, we obviously see that there is an inflection point which gold is going through. And for this reason, we thought we'll look at something, a metric that we closely track, which is the Nifty to gold ratio, which actually kind of it's an equity risk premium equivalent of the gold equity market relationship. So when we look at this particular ratio, we've seen that in the last 10 years at least, this ratio rarely falls below 100. And whenever it falls, it's obviously preceded by a very large, macroeconomic disturbance. We saw that in 2016, the ratio fell below 100. It went down to closer to 90. But after that, the period post that, as you can see in the chart, the Nifty had a very, very strong rally. We saw this again happen during COVID, which again was a macroeconomic disturbance. The ratio touched 100, then it fell down sharply to about 60. But the reversal was equally sharp, right? So over the next 6-7 quarters, we saw the Nifty do a very Nifty undergo a very, very strong rally. Similarly, when you see the extreme right red dot, this is where we are right now when we're talking about this ratio. We believe it's time to start booking profits in gold and reallocating it to something like an equity market allocation, because what we are saying is that this ratio has reached a threshold. We will obviously not know where exactly the bottom will be formed, but at least the risk reward is extremely unfavorable for gold at this point in time. Now, when we look at all these allocations, the obvious question is that what are we doing with respect to our own portfolios when it comes to managing volatility? I'll invite Shankar to kind of come in and talk us through about how he's thinking about EFQ in these volatile times. Over to you, Shankar.
Thanks, Saurabh. Given that the general, at least our house view, and I think many would resonate with this, is that it's an attractive time to be invested in equity markets. I thought it might be good to just share this long-term performance chart of the EFQ portfolio. The primary objective of this being, there will be different points on this chart when if you had started, then you would have realized different types of returns. If your entry point is attractive, then the long-term return that you really get also tend to be attractive. They are high teens, maybe upwards of 20% compounding, and so on, right? And when we started this fund, which was somewhere around September, October 2022, we had just crossed out a similar period of drawdown. And since inception, from that point in time, we have generated close to 20% CAGR, right? Now, what this basically tells us is that if our starting point, our entry point is attractive, it's a good time to kind of be staying invested, because in the long term, you start realizing reasonably good double-digit returns. Given where we are in the macro scheme of things, given where we are domestically, how things are looking favorable, etc., from an equity investing standpoint, it might be a good time for us to kind of consider topping up on EFQ allocation, or kind of generally topping up equity allocation, specifically EFQ allocation. Go to the next slide. How are we specifically looking at this opportunity? We are looking at this opportunity to expand our investment horizon. So we are basically looking at few things. One is we are trying to add multiple sources of alphas through multiple alpha models. What they will do is they will end up capturing different uncorrelated uh, sources of returns, different dislocations which exist in different pockets of the market, so that we are able to capture a lot more than what we have been capturing so far. We are using this opportunity of expanding or increasing equity allocation to do that, because now opportunities are also going to be available more than what they were in perhaps a raging bull market, right? We are also trying to increase the spectrum of investment opportunities which we have. We want to now be present and have an ability to invest across many more industries than what we are currently investing in. If we basically just specifically talking about the fact that if you were to include small cap companies, out of 120 odd industries which are present in the Nifty totally, the NSE totally, I'm sorry, about 95 out of those 120 odd industries are getting represented when you can also consider small cap along with the large and mid cap exposure. We are missing out on a lot of that if you were only focused on large cap or only focused on large and mid cap, right? So we were expanding our opportunity set. But at the same time, we are also cognizant that when we try to capture newer sources of premium returns, expanding our universe to smaller companies a bit, we also want to make sure our portfolios are reasonably robust, reasonably diverse. So we are also trying to expand on the number of holdings we are having to somewhere around 45, 50 from earlier about 30, 35, with the objective that we don't want to take too much of company specific risk. We are perhaps okay taking more of an industry risk or a sectoral risk or a thematic risk, but not so much a company specific risk. You can go to the next slide. But having said that, there are no certainties in the market, right? On one hand, we definitely believe that it's a good time to be invested in equities, but there's no point in basically trying to time this to perfection, because markets are uncertain. So we are going to have a strong hold on our tactical risk management piece as well. The biggest solace we derive out of this tactical risk management is that it is a very fast moving indicator, which is something which while we are tracking it on a daily basis, we are implementing it on a weekly basis from the perspective of managing churn, so that we don't end up buying in and out of the portfolio too frequently. This is a momentum-based risk management framework, so it is going to follow market movements, sentiments very quickly. So it's not going to wait for too long to enter back into the market. It is not going to wait too long to stay invested in the market if the sentiment reverses. So we are kind of playing a barbell sort of approach, where on the one hand, we are expanding our horizon. We are trying to take out more opportunities where we can succeed. But on the other hand, we are also trying to make sure that the short-term volatility that exists in the market, we want to kind of make sure we are protected for that. We want to make sure that we are not caught off guard if things don't play out the way we expect them to play, because that can happen, right? The only reality of the market is that it's not certain. So this is what I wanted to speak about with respect to EFQ. But as always, the last section, which is perhaps my most favorite section, is to talk about how, as an organization, we are managing volatility. And I'll let Prashant talk a lot more about how we are doing that on the TB1 front.
Thank you, Shankar. Welcome, everyone. This is Prashant Bisht here. Like I spoke in March, managing volatility is not just about looking at risk, but also looking at opportunities, right? So, for example, in such a volatile environment, an investor could have made 8% more than the market index by investing in True Beacon 1, which is the AIF that we have for our domestic investors. The challenge in a volatile environment is that markets will swing both on the upside and the downside, and that helps balance strategies like our True Beacon 1 fare much better, right? Because there are a lot of investors who in this volatile time, let's say, are on the fence and invest in the fixed income market as compared to the equity market, suddenly realize that there is a big swing and they miss out on this opportunity. So just taking True Beacon 1 as an example, this is a fund which tries to balance equity exposure by putting some part of your capital in the long only equity, some part of your capital in short duration government securities, and rest trying to use both this as collateral to squeeze in more returns out of the market. So in a highly volatile time, a balanced fund or balanced strategy presents that opportunity to investors. And it may again not be relevant for all investors, but for some investors, it might be important to manage these volatile times. If we move to the next slide, I'll just give a concrete example of how, let's say, returns would have changed for a balanced fund investor who would have invested in Nifty 50. So this is a chart comparing financial performance of last year. This just gives a range of outcomes that a investor can look at. So the first line shows that TB1 did fairly well, like I mentioned. It outperformed Nifty 50 by close to 8% alpha, whereas let's say some other back product would not have done well. Again, the nature of the markets is such that even having a balanced strategy, what that allows the investor to do is try to ensure that while there are opportunity costs of not being in the market, they have got some exposure. So in this case, for example, in TB1, they would have 50% exposure to Nifty 50, and then rest exposure to fixed income or other kinds of trading strategies would ensure that they do better. So again, like I mentioned, these strategies work great for investors who are worried about volatile times, who are not sure how this market environment will play out. So for those investors, for certain type of allocation, they can look towards a balanced strategy, and hopefully that balanced strategy is TB1 where it fits in. So that is kind of what I just wanted to share my and Trubeacon's experience on how we are trying to manage volatility by choosing allocation to different kind of strategies, in this case, the balanced advantage fund. So that's something from my side.
Sure. Thank you, Prashant. I hope you're all good with the audio at this moment. Quickly, just to give everybody like a wrap up, right, in terms of a recap of all the things that we have addressed, just want to hit upon three primary things that we're trying to convey as, a takeaway from this conversation. Number one, after the significant rally in gold, we are officially sort of scaling back our overweight stance on gold to neutral. And this is after the strong rally. Saurav spoke about this in more detail. Also, something to reiterate is that on the debt front, after having seen that, a large part of the rate cuts have already been priced in, we are booking profits in some of the exposure that we took for multiple clients when it comes to the long duration debt that we had in the portfolios. And after having locked this profits in, we are shifting towards more of a balanced duration sort of positioning on our debt book. And thirdly, Shankar touched upon this as well, so did Prashant, that given the market environment at this point, as much as we are seeing equity risk premiums seeming a little more attractive than they were, we're still maintaining a hedged stance on equity and are proposing multi-asset strategies to all of our clients to sort of navigate these tariff-induced volatility and all other macroeconomic shifts that we've covered. So I think these are like three key takeaways from a portfolio positioning standpoint. And of course, with that comes we come to the end of the prepared portion of this and move on to Q&A. I can see that we have a lot of questions that have come in already, and I encourage attendees to put in questions. Even if you're not able to answer it live on the call given time, we look forward to having the RMs reach out to you directly. So we'll just move on to Q&A. You can take off the slide expert. All right, perfect then. So we have Prashant, Shankar, and Saurabh here. Thank you for that. Thank you for your insights. So we'll just start off with a question that we have regarding equity factor quant. So Shankar, maybe you can take this, but we have a question regarding what's the current cash position like, and also like how do you see that evolving, right? You spoke about the risk management strategy, but given current times, do you expect those cash positions to stay elevated and so on?
Yeah, sure. So maybe I'll spend a couple of minutes talking about how we have defined this tactical risk management problem. It's a constantly evolving process. It's not like there is a process which we have decided and now we will never change it. But I'd maybe spend some time talking about where we are right now with respect to that. Then talk about what the cash positions are going to be, and then maybe also talk about why we think this cash position makes sense, despite the fact that there is general view that we have that it might be a good time to be allocated to equities, right? So basically, this tactical risk management framework, right, is a combination of certain trend following signals slash indicators, which try to understand and identify what is the momentum that persists at the market level, what is the momentum that persists at a stock specific level, and we are also evaluating what is the momentum that would persist at separate industries with respect to the broader space, etc. Right? But having evaluated the momentum metrics across these three parameters or four parameters that I just spoke about, it's not like we are looking at it in a silo or we are looking at it once every month or once every quarter. So our core portfolio may get reevaluated once every month, but this is something where we are being much more dynamic about. We are looking at signals. We are actually measuring those signals daily, but we are acting on those signals on a weekly basis, purely from the perspective of making sure that we don't churn in and out of the portfolio too much, because on a weekly basis, the signals can tend to get a bit noisy, right? Now, when we make these churns, we should also be cognizant of the fact that because it's going to chase how the market sentiment is, it will for sure not capture inflection points to perfection. So if market had bottom and it's now recovering from that bottom, this kind of a risk management book or risk management framework is not going to be able to precisely time the bottom. But it will definitely help in picking up pace with respect to equity allocation, getting more aggressive as time goes in a reasonably quick time frame. It is not going to also wait for months and quarters and half-yearly periods to come back to full allocation, right? So that's just the nature of this risk management, the way we have built it. Also, on the flip side, it is not going to be that if markets stumble from here because of, for whatever reason, our hypothesis doesn't play out, it's again not going to be sticky at that level of equity allocation. It's going to reduce its equity allocation sequentially, week on week, etc. So this is how we have defined it. Now, the specific question with respect to what our current cash positions are, that's between 20 and 25% as we speak. This has actually been a step down from our equity allocation has actually gone up from earlier. At one point in time, it was close to about 60% equity allocation to now we are at 75% allocation. Markets are strong right now, and hence, as by nature of how this risk management module has been evolved and has been built, I expect the equity allocation to keep going up sequentially. That's not to say, next week it's going to go up to 80% and 90% and so on. I don't know the timeline on that, but I generally expect that the equity allocation is going to go up in the recent term. Third is, why even have tactical risk management given we have a bullish stance, right? Like I said, having a bullish stance is like having a view. But because we are doing portfolio management, we can assign probabilities to those views. We can't assign certainties to those views because these are all probabilistic in nature. Nobody knows what exactly is in store for us, all of us tomorrow, right? So we have to make sure that we are positioned well enough that we are able to take advantage. If not advantage on both sides, at least we are not worstly impacted or significantly adversely impacted if the hypothesis which we hold out does not play out. Right? And specifically with respect to where we are in the macro cycle, specifically with respect to how things have evolved, the risk largely seems to be a risk on equity rather than risk on specific names, right? And hence, what we have done from a portfolio slight realignment perspective is we have tried to take this barbelled approach, which I briefly touched upon when I was speaking about it. But on the equity side, we are enhancing or increasing our horizon so that we get more opportunities to play from. We get to pick more dislocations. We get to play with multiple models. So the upside is a bit higher than if you were to pick only one model or we were to pick only a small subset of companies to operate in. On the one side, we are doing that. On the other hand, we are also keeping the tactical risk management alive, that if it doesn't work out and hence there is an equity risk that actually plays out, it's not specific to, okay, small caps are going to get affected worse as compared to mid and large caps. Across the board, the problem is going to be there. So our tactical risk management, which has a small caps component right now, about 20-25%, that is going to also help us in reducing some of the drawdowns or volatilities.
Sure. Thank you, Shankar. That was helpful. Prashant, we have a question. I think you should take this. This is regarding the use of derivatives in the True Beacon One strategy, right? Like, I think Soma, the question talks more about, is that adding to the risk, because derivatives are usually, interlinked with higher risk sort of instruments. So does the use of derivative add to the risk, and how do you use it to sort of do the things that you said True Beacon One is able to achieve?
Right. So basically, the way to think about derivatives is maybe similar to the way you would think about trade relationships, right? It's a complex entity, and it is not about whether, again, trade relationship derivatives are good or bad. It is how you use it. So that is the key thing that we have to realize, that again, very similar to, let's say, what we are discussing about international relationships, right? With derivatives, the range of possible outcomes is huge, and whether it is positive on the positive side or on the negative side. And our assertion is that we have been trading this for 5+ years. We have got a big team with a lot of experience trading derivatives for a long time now, and we have built systems, researchers. So we think we will land up on the right side of the trade usually. And with derivatives, it allows us to do a lot more than plain simple vanilla trading. And that is the beauty of a fund like a True Beacon One fund, where if you are able to handle the complexity and the risk well, you will on an average do much better than the market. And that is the reason why we are able to, for example, in last year, right, we were able to do 8% more than Nifty 50, which is a significant achievement at half the volatility. So I think it's like, just to rephrase, right, it's not about whether derivatives are just bad or good. It's a complicated thing, and if you handle them well, then they're a good source of alpha.
Sure. Thank you, Prashant. Saurabh, this one's for you. We have a question regarding, like you spoke a lot about what we could possibly do with clients in terms of gold and debt offerings and so on. But again, like I think most clients are invested with us primarily for our equity-oriented offerings. So could you give a little bit more insight into how they can engage with us in terms of these, other products and services that we have?
Right. So basically, for a large number of our clients who wish to have some allocation to debt, it could be because of their risk-averse stance towards the equity markets, or it could be because they want a certain pool of capital to be readily available for any exigencies. So we typically have approaches such as bespoke debt. Then we also have allocations that we make on gold across these investment approaches, and basis the team's understanding of the evolving dynamics of which means basically evaluating the relative attractiveness of the debt market, the pockets in the debt market, the gold as an asset class. These evaluations are done internally by the team, and accordingly in these approaches we take actions with respect to client portfolios, which are obviously aligned with the client objectives. Now, some of the clients may not be too eager to have a long duration debt in their books, but we try, if we are raising duration for such clients, we do it to the extent as possible. Although we do give our own advice, but at times clients may not be in a position to kind of weather MTM impact on their portfolio, because long duration debt can be slightly more volatile, slightly more harmful, as well as beneficial to MTMs of portfolios. So we typically do this through our approaches internally with respect to these asset classes.
Sure. Thank you, Saurabh. Shankar, maybe you can take this one, but we have a question regarding if there are any specific limitations or advantages for NRIs to invest in the quant product that we're discussing here.
Maybe we'll get the compliance piece sorted out. There could be certain geography-specific restrictions to certain NRIs belonging to maybe Canada or US. I'm not 100% sure. Maybe we'll circle back with the RMs after having consulted with the compliance team.
No, absolutely. I think, to the person who asked, we'll make sure that we reach out to you individually, understand what the situation is, and give you a more nuanced answer on that front. But yeah, broadly, like Shankar mentioned, apart from certain geographies, there should be no particular limitation, at least. Like it should be fairly seamless. Outside of that, like I think we have a quick question. Again, probably Shankar or Saurabh, you guys can help with this. But we have a question regarding individual whose point-to-point return based on the last several months seems to be in the underperforming territory. While that is normal, like how do you see that evolve, right? Like, do you have at Truebeacon, can we provide any sort of indication in terms of recovery period, or when can they expect getting back to base and positive territory and so on?
Yeah, maybe I can take a stab at it, and Saurabh, feel free to add. But basically, the
Shankar,
thing
you
is,
want to try turning your video off and just yeah, you can bring it back. Yeah, perfect now.
Yeah. So maybe I can take a stab at it. So the intention of showing that first chart, which demonstrates the long-term performance of the same fund, and this is not back-tested data, this is actual live data of the fund since its inception, just goes to show the point that over a period of time, there's an alpha which gets generated, right? But there may be prolonged periods of underperformance also from individual portfolio perspective. This is in line with how equity markets evolve, that there will be periods if you invest in, like let's say, for example, if you had invested in July 2024, which was pretty much the peak of the EFQ portfolio, and you would have seen negative returns subsequently, right? And the same would have been the trend in the markets as well. The percentage or the quantum could be different for markets versus for us, and any zoomed in portion of this entire chart will throw up dislocations like this. But if our general expectation is that equities are going to do well in the medium term, because all of the things that we have mentioned with respect to equity risk premiums looking more attractive, equity to gold looking more attractive, flows turning positive, and so on, these are not things which guarantee outperformance or guarantee strong equity performance in the next month. It just goes to say it's an attractive point for us to be entering into equities at this point in time, right? And given that as one statement, and the second fact, which is like over a long enough time frame, the strategy starts demonstrating its longer term properties, which are aligned with what the backtest also demonstrates, right? So when you do the backtest for a strategy like this, you would expect to see somewhere like a 7-8% alpha over the market. As markets grow more efficient, maybe that 7-8% alpha becomes a 5-6% alpha in realized time. But even in the backtest, there will be periods where you don't outperform significantly. There will be periods where you underperform, right? So that also plays out in reality. But as you expand your horizon from 1 year to 3 years, the probability of outperformance perhaps goes up from somewhere in the 60s to somewhere in the 75-80% range. As you expand it from 3 years to 5 years, that number goes up even further, right? So the general sense is equities are looking up generally, and hence maybe a good time to invest in equities. And B, because in the medium to long term, EFQ tends to do well and generate alpha, it makes sense to do that equity allocation in a product like EFQ.
Got it. And if you could just add, Shankar, on if there is any particular sort of time horizon that you can compute based on recovery periods, or when people can expect to be back from a drawdown? Because again, given the quantitative nature of the strategy, is that something that we can give direction towards, or is it more of a long-term play, like you mentioned?
It is a long-term play. So, like I told you, right? So if I had to just look at 1 year periods, right? You would expect generally, if I told you, okay, I have a strategy which generates a CAGR alpha of about 5%, 6%. If I told you that as a proposition and at a similar volatility, one expectation could be that this 5 to 6% comes every year. But if we actually go and look at the data, it's actually just about 60% of the time spent on a 1 year basis. You are even generating an alpha, leave alone a 5 to 6% alpha. But there will always also be 1 year period where you're generating 20-30% alpha. So it's not at all linear. So a 5% underperformance followed by so actually this even in the why talk about backtest, right? Talk about the life history of the fund. When in the first 6 odd months of this live start of the fund, we were, I think, sitting on somewhere around the 6.5% negative alpha with respect to the benchmark. I could get the numbers off by 1% or so, but broadly that was the trend. And then in the year that followed, we generated an alpha of close to 25 to 30%. Right? So over a long period of time, these numbers look like they're very linear, and hence you can stitch a clear, easy narrative saying, okay, 6% alpha we'll make. But when you zoom in, like I said, it could be vastly differing pictures. So it may not be prudent to say, okay, in the next 6 months, let's expect a 20% alpha. That may not happen.
Got it. Thank you, Shankar. So we have a couple of other questions, but mostly, things that will require more individual sort of nuance to it. So we will not open it up on this forum, but rest assured that the RMs will reach out to you directly. I think with that, we'll sort of come to the close of today's session. Like, I'd like to thank everybody for joining us at this critical time. Like, I know it's been very happening in the markets these days, and we are glad we could share our sort of take on it with everybody and give a sort of update on product positioning and so on. Any unanswered question, like I mentioned, we will address directly. Your relationship managers will be reaching out to you to sort of take you through the nuances of the situation, or the compliance-based problems that you have indicated. We appreciate your continued trust and interest in TrueBeacon and remain committed to being your long-term partners in navigating these markets with confidence. Wishing everybody a great week ahead. Thank you so much for joining us today. Thank you, team.